Good afternoon and welcome to our weekly webinar. I'm Kathy Fettke, co-CEO of Real Wealth Network, and I'm going to be giving my 2019 mid-year housing update. I gave this at our live event this past weekend, so if you were there and already heard it, well, you get to hear it again. I'll probably have some new information on it, but a lot of it will be the same. So welcome. It's great to have you here. Boy, we live in an interesting world, so I'll try to break it down as best I can. Please understand, I am not an economist, but I do my best to use common sense to understand what's going on because I'm not even sure if you studied economics, if you could make sense of our current situation. So I think the most powerful thing we can use today is our common sense. So I'm going to show a lot of slides. I'm not going to do any forecasting or predictions. I'm just going to show slides that will help you make your own predictions and forecasting based on some of the data that's out there and an explanation of some of the headlines you see that may or may not be real news. All right, so let's get started. Again, I'm Kathy Fettke, co-CEO of Real Wealth Network, and this is my 2019 mid-year housing update. Let's have some fun. Here's the disclaimer. Again, I am not an economist. I am a real estate investor sharing information and data that I've gathered that helps me make decisions when investing in real estate. But borrow what you want from this information, but do your own research as well. And before making any financial decision or investment, always seek your own personal advice, your advice from your personal advisors, which would be your accountant and your attorney, to discuss your specific situation because it's different for everybody. Of course, past performance is no guarantee of future results. We can look at the past as a guide for the future, but I can assure you it's not going to help in predicting the next 10 years because the next 10 years are going to be like no other 10 years you've ever seen in history. It's the world 10 years from now is not going to look like it does today. So that's important to understand when working on your investments. Again, while every effort is made to maintain accurate and current information, the possibility of errors or updates always exist, and that's why it's on you to double check everything you do, everything you hear with your own research, so that you can make wise decisions. All right, so let's start with headline news. As you may or may not know, my past and current, I guess, situation is that I got my broadcast degree at San Francisco State University. And I worked in the newsrooms of KTVU, which is Fox News station, and then I worked at ABC News and CNN. And I understand the news. And basically, the idea is just like anything. They want an audience. They want an audience so they can sell advertising. In order to get an audience, they need eyeballs to be looking at them. Their whether it's TV or radio. Well, radio would be ears, but they want an audience, and to get that audience, oftentimes, if it bleeds, it leads. That's kind of the idea. If it scares you, you'll watch and you'll listen. So most headline news is meant to scare you so that you'll read the article or watch the news story, and then they can sell advertising. So let me just be the voice that tells you don't fall for that. Don't fall for that because oftentimes, most of the time, they're wrong. When I was a news reporter, I was given a probably 5,000 page, it felt like it was probably just a few thousand pages of the new healthcare plan. And I was given 20 minutes to read it and report on it I forget which station, but there was no way that was possible. So again, a lot of times the headlines are written by people who are just trying to get your attention versus people who really deeply understand the topic. So again, it's up to us to dig in deeper. So let's dig into this headline, which is, you hear it all the time. We are now in the longest expansion in our history. But what does that mean? Well, it's the longest, but not the biggest. So, again, what does that mean? From 2009, when the recovery began, till now, GDP growth has been about 24%. And what does that mean? Gross domestic product, that's the output of our country. But back in the 60s expansion, that GDP growth during that expansion was 51%, so more than double this expansion. And then in the 90s, it was 42%. These are two long expansions, not necessarily from a time perspective, but from an output and production perspective. So we're not even close to that. And why would that be? 10 years, a long time to be building economic output, but we didn't even come near expansions that were shorter in time. So, what's going on? What's underneath that headline? I think we can all remember this day. It was in September of 2008 when the huge financial giants on Wall Street collapsed, including Lehman Brothers. And boy, that was a terrifying time. I told my husband to buy guns, and I think I was buying a bunch of stored food items that could last for 5 years and stocking water. I didn't know what was going to happen to our economy. And if you watch The Big Short, you would know that the White House didn't know either. They had a meeting at Congress where apparently our uh, our politicians were told that the economy had collapsed and the banking system had collapsed, and it was pretty dire times. So when you look at it from that way, that our economy flatlined just 10 years ago, and here we are 10 years later, just a massive abundance out there. I mean, people constantly talking about the economic growth, the low unemployment rate. So we've got a pretty booming economy considering it was dead last decade in 2009. But it's been basically a slow growth, a slower growth than normal, but it's probably because we were down further than we'd been in the past. So when you look at this chart, like what was the cause of the expansion this time around? And really, when we look at this chart, it comes down to the money supply. These lines here represent recessions. And after the last recession, look, a lot of money was poured into the system to get it going again. And that was through quantitative easing, which is just a fancy Wall Street term for printing money out of thin air. So a lot of money was printed out of thin air and thrown into the economy. And that works. Give people money, they'll spend it. Our economy is based on people spending. We have a consumer society. So if you give them money and they spend it, then we'll get things going again. And it worked. The problem is, it's not a real economy. It's an economy based on fake fiat money. If you look at this chart, back in I believe it was 73, Nixon took us off the gold standard. And that meant that any money that was printed out of thin air had to be tied to the amount of gold we had. But we needed more money, so why tie it to anything? How about just untie it and just let it go wild? And then politicians can have anything they want, and we can create money, and politicians can get reelected because they can make promises for health care and free education and college and whatever it is they want to give the public so they can get reelected. Well, boy, it's a lot easier when there's money to do that, and it's a lot easier to get that money from printing money instead of taxing people. So look at that. We just have gone a little nuts with it, haven't we? Printing lots and lots of money to be able to get that economy turning and get taxpayers what they want, which is more stuff without paying taxes for it. So that's where we are today. But what does it mean? What does this mean? My understanding of what our forefathers wanted with our government was that we would not do this, that we wouldn't just print money. In fact, it's my understanding that the Constitution doesn't allow the government to print money and create money because if you keep doing that, well, the money becomes worthless, right? If you just, it's worth basically the paper that it's printed on. If you can just keep printing it, money's supposed to be in short supply, not just create out of thin air. So our forefathers didn't want us to have the ability to do that. But what they did say is we could borrow money, and that's what's happening. So the Federal Reserve can print the money and lend it to the government. What a great business, huh? What a great business that you could just create something out of nothing. Today, you don't even have to print it. It's just a digit on a computer, and then you can lend it to someone and charge interest. So it's a great business. I'd love to be in that business, but it's limited to the Federal Reserve. Federal Reserve banks a lot of people wonder, what is the Federal Reserve? Well, it was created in 1913. I believe some of our forefathers really tried to not have this happen, to keep control out of the control of politics out of the hands of the banks. But anyway, uh, the banks won and created the Federal Reserve. But what's important for people to understand is that the Federal Reserve is not federal. It's not a part of the federal government, and it doesn't have any reserves. But they do exist because of an act of Congress. So Congress approved it. Kind of works. It's a great relationship because politicians want money. The Federal Reserve can print it, lend it to them, and they can enact the things that they want to get reelected. And the Federal Reserve has been given the ability to basically moderate the economy by letting that money flow or not. So if the Federal Reserve is allowed to print the money and make it really cheap to borrow, well, then you have a booming, usually a booming economy. Because let's face it, if you or I were given $1 million with no zero interest payment to make on that, you'd borrow it, right? And you'd go spend it or create jobs or, hire people. So that's the idea. But if the economy gets too overheated and it's pumping along too much and that's causing inflation, well, then the Federal Reserve can make that money more expensive. And when it's more expensive, I mean, can you imagine borrowing it at 18%? Well, you might not do that. So then you're not going to run out and buy as many things with that interest rate. And you're not maybe even going to borrow it to begin with and maybe not spend it as recklessly. So that's kind of how the Fed has monitored the economy. But we've got to remember the Fed is not the federal government. It is the banking system. The largest banks participate in this monitoring of the government of the economy. That's interesting to understand and important to understand that who controls the money flow, therefore the economy, is the banking system. So they're probably going to have their own they want to survive, right? So a lot of that policy is going to affect whether they can survive or not. Now, this chart shows, again, these recessions. These are these lines. And these are interest rates, this line here. So if you'll see, uh, here's a recession. Interest rates are lowered to try to pull us out of that recession. It takes a while usually. You could start seeing the signs of the recession here. People often see it too late. Bam, there's a recession. And right there. And then the Federal Reserve tries to lower rates to stimulate. Well, that stimulus usually works. And so it works so well that the Fed has to raise rates to slow it down. And boom, raising rates, tightening is what they call it, often will lead to another recession. So, then they had to lower rates, everything booms again. And so they have to raise rates and bam, another recession. See that? It's kind of a pattern. So in our last recession, you'll see there wasn't a lot of stimulus that the Federal Reserve could do because the economy had flatlined. So the Federal Reserve just made money almost free to borrow, almost no interest rate on that to borrow for banks, which then could lend it out to us at about a 3% margin. Um, but it was there for a long time because that's how bad the economy is. You see in history, rates have never had to be so low for so long. Usually you lower them, things pick up, and you got to raise them, and it's this up and down thing. But boy, they had to stay low for a long time to get things going again, which again is concerning and important for us to understand why this may be the longest expansion, but not the biggest, because we were coming up from zero, from basically dead. So basically the Fed was like, take this money and spend it, but it wasn't really happening. If you recall, interest rates, boy, you could get a loan for 2 or 3%, and home prices were super low at that time, but I couldn't get a loan at that time. I had done a short sale. I was stuck. There were these great deals, but I couldn't borrow the money. So just because the money's cheap doesn't necessarily mean it circulates. So a lot of that money just went into banking reserves, and it went to a lot of corporate giants that could borrow that money and invest it in the stock market, which brought that back up. As things started to get heated, the Federal Reserve thought, okay, it's time to just see if we can handle a rate hike and just tighten a little. And then everything was okay. They held for a while. It was kind of like, oh, can the economy handle this? It did. So they raised a little bit more and a little bit more. And then last year they raised 4 times. And guess what? That was the turning point. That's when we felt it. So we saw housing slow down last fall. We saw some shaking in the stock market. And it's interesting because here, where we hit sort of the peak of tightening, like, ooh, this is as high as we can let it go before we see a recession, that's actually a level where in the past we considered it a stimulus. And even higher than that was considered a stimulus. Rates were what here, like 4%? That was a stimulus, 5%. And then, so to be down here at 2.5%, and consider that a problem, interest rates are too high, it's slowing down the economy. This is concerning. This is concerning for a few reasons. One of the reasons is, what are we going to do if we do hit a recession? We can't really lower them that much more. If so that a lot of people say the idea and the reason the Federal Reserve even raised rates to begin with was so that they could have some ammunition if there's a recession to lower those rates. So again, interpret it as you like, but it's just important information to understand a little bit what's going on. So all of that free money, basically, remember I said Nixon took us off the gold standard in 73, I think it was 73. GDP growth was pretty steady because you didn't have all this money just being thrown into the economy, basically fake fiat money. But once we did, it really affected our output. So I guess you could say that's good. It's, our country is strong and our economy's been strong for the most part. We've had the highest GDP in the world. So, maybe it was a good idea, maybe not. It affected job growth. Look at that job growth increasing over the years. It certainly affected the Dow Jones, the stock market, all that money. Home prices. Excuse me, this chart doesn't go back to the 50s, but if it did, this would just be a blip. But home prices were certainly affected by all that free money. When it's easy to borrow, people buy houses. Why not? And then, basically what happens when all that money is circulating, people can start businesses could hire, and that's what's happened. We've had 5.9 million, let's see, hirings increased to 5.9 million in April, the highest level since the Labor Department started keeping track. What's interesting about that is that total job openings exceeded workers by 1.6 million. So in other words, we have more jobs than workers now. That's not necessarily a good thing because that means businesses can't find the workers they need to be able to get the job done. For many of us in the real estate industry, it means that people like us, when we're syndicating, when we're buying land and wanting to build houses because there's so much need for new homes in certain areas, what happens when you can't hire workers to build those homes? The first thing we look at when we syndicate is, wow, this land is a great deal, but can we get the workers? And that's a big important part of it. And then how much are we going to have to pay them? We're going to pay them more because it's hard to attract them. And are we going to have to house them because they're not in the area? We're going to have to import these people. And if that's the case, boy, we're going to have to increase the price of the house. And that creates inflation. That's basically called, it's on this slide. This shows there are now more job openings than people who want them. So low unemployment is both a positive and a negative, and it's important again to understand that because you constantly hear headline news about the low unemployment rate, and everybody looks at that as a super positive thing because it means there's lots of jobs, right? Lots of money circulating, things are good. But when we look historically at what that means, this T is weird on this, but what this is supposed to say is the death of the Phillips curve. The Phillips curve is basically a theory that when unemployment gets too low, then employers have to pay so much more for salaries and benefits and bringing people in and moving costs and so forth, that has to be passed on. That cost doesn't get eaten up by the company. They pass it on to the consumer. And if it's passed on to the consumer, that creates inflation. And if there's inflation, that's the number one gauge that the Federal Reserve uses when deciding if they're going to raise or lower interest rates. So when they see inflation, they raise interest rates to slow things down. And if inflation isn't slowed down, they keep raising them until, boom, we get a recession. So this is a metric that needs to stay in balance. And right now it's a little bit out of balance where we have low unemployment rate that's driving prices up. It's one of the biggest problems we're seeing in housing and why home prices are so inflated is because lack of workers and also in addition to that, the higher tariffs that's increasing um, material costs. You've got higher labor costs, higher material costs, higher cost to even get the permits and all the things that locals want, the new roads and the new streets and the school fees and so forth. All those fees are going up, environmental fees, and that's getting passed on to the consumer and creating inflation, certainly in the housing market. And again, that's a problem when the Fed is tracking that. So the Federal Reserve has been saying we're just going to have to keep raising rates to slow all that down. But then the president of the United States said, no way, not on my watch. Because why? Well, he's in the midst of getting reelected. He doesn't want a recession in the next year, right? That wouldn't be good for him. So there's been a battle between the POTUS and the Fed, basically the president saying, I'll fire you if you raise rates, and the Fed saying it's none of your business. We're supposed to be independent of you. That's supposed to be the case. But interestingly enough, we saw a turn of the tides, and we saw our Fed chief, Jerome Powell, say, yeah, okay, we're going to hold. We're not going to raise rates. And now the big headlines are, in the next meeting, we might lower them. So the president is basically getting what he wants. What does that mean to us? That means that if we've got a president who seems to understand the impact of real estate and rates on real estate, and he's of course a real estate investor, he wants to keep those rates low, keep the economy booming. It affects his assets and his portfolio, and that affects us too. And it's going to affect his ability to get reelected, and that affects us too. So basically, there's a really good chance that we're going to have a stimulation, keep the economy going, buzzing along a bit longer as a result of all this. But how will it affect housing now and in the long term after the election? This is what's so important to look at because what we have is probably a scenario where things are going to be booming at least until the next election. Eventually, there's a price to pay for all of this. And that's more the longer term view we need to pay attention to. So when making short-term decisions, I think you can feel pretty good about the fact that we'll probably have a continued economic expansion this next year. How does it translate to 5 years from now or 3 years? If you're looking at, like in our case, should we have another single family rental fund? Should we be buying apartments? Should we be building new homes? Should we be buying more single family? Like what should we be doing with our money if we're thinking beyond this expansion into the next? When might that recession hit? Because they always do. Well, here's what we know. We know that in the past 10 years, we've had population growth here in the US. So when comparing today to the last recession, we have a lot more people here. We have over 20 million more people. And in addition to that, we have wage growth. We have low interest rates, even though we talk about them going up. Right now, they're really low and they're down again. We have household formation. We have more people looking for houses, but not necessarily more people buying homes. So what's up with that? What's going on? If all of those things are true, higher wages, higher population growth, more household growth, wouldn't more people be able to buy a home? So again, what's going on? Well, one of the things that's going on is what I've already said. Home prices have gone up past the wage growth. It's just our industry is booming. It's impossible. I'm sorry, it's impossible for builders to build new homes at affordable prices. I mean, some of our affiliates are managing to do that, and that's really incredible. We have affiliates in Texas and Florida who are able to build homes for under $200,000, which is really hard to do. But those areas, Texas and Florida, make it a little bit easier on you because they have less fees. I think that's going to change. It changes all the time when prices grow up. When prices go up, then people tend to um, rise up and say we need an end to this, and that affects the process, and they start to see the kind of regulations we have in California in areas where there's been so much population growth already and home prices are up so high. You start to see some of those tactics implemented in other states, and it's not necessarily good for them. So in the future, there could be more regulation in Texas and Florida, but right now there's not. So right now, there are some places where you can buy a new home for an affordable price, but most of the country you can't. So we've seen home prices go up much faster than wages have gone up. But the big thing is this debt, consumer debt. There's so much money out there. As I showed you, the money supply is massive. That's a lot of money floating around. And when money's floating around, it's looking for a use, right? It's looking for someone to borrow it and spend it. So banks are trying to get people to borrow it. And as a result, they are. So the average American has a credit card balance of $4,293, which credit card debt, which is the highest ever, surpassing $1 trillion. That's important to understand. And coupled with that is the student loan debt has tripled in the last decade. It is so easy to get a student loan. It's horrible. I know kids who come from families that aren't able to pay for college. They don't have the savings. Maybe they don't own homes. They don't have a nest egg. But that kid's still able to walk into, like a California kid wants to go to Boulder. They're an out of state student, so they have to pay double. So instead of a $24,000 a year tuition and with housing and food, it's $52,000. But you know what? That California student can walk in, just sign the loan agreement and walk out with a loan for that. I mean, I don't know about you, but would you give a 19-year-old with no job who's going to study women's studies or sociology, and would you give them $200,000 so that in 4 years they can start paying you back? I mean, it's nuts, but that's what's happening right now. It's loose money. And unfortunately, even if all of these people default, it's not going to take our economy down. So that's not the problem. The problem is they can't qualify for good debt. They can't get good loans because they can just walk in and get a new car. They can walk in and get a college loan. They can walk in and get a credit card. And now they have all this debt such that they can't qualify for a home, the kind of debt that's going to make them wealthy. So that's the sad news in all of this. um, Massive student loan debt right off the bat. These young kids, age 22, are coming out of college in debt, in massive debt, $1 trillion in debt, just in student loans, not including the car and the credit cards. Now, it takes about 21 years to pay it off, just the student loan. And there's 44 million borrowers. Now, back in the 80s, when I graduated, well, when I went to college, it was a problem. People had, student loan debt, but it only took about 5% of the income that they made once they got out of college. Today it's 20% or more. 10 to 20% of their income is just going to pay off their student loan debt. Well, that's going to throw off their debt to income ratios such that, again, they can't qualify for the good debt. So it's a bummer. And I'm not saying that a student loan is bad debt if you're going to be a doctor and take on a big student loan and walk out knowing you're going to get a $200,000 salary. I'm talking about the person who gets out with a $200,000 loan and they're working at Starbucks. That's a problem. That's going to be very difficult for them. So unfortunately, it's us, the taxpayer, who's going to have to handle all these defaults. But it's not going to take the economy down. It's just going to create a lot of renters. Again, this is headline news, another sign we've become a renter nation. Renting a 3-bedroom property is more affordable than buying a median priced home. So people are renting. It's renting because they just can't qualify, even if interest rates are going down. It doesn't matter. All that matters is that they can qualify. Now, when I said it's easy to walk in and get a loan, It is for a car or a student loan or a credit card, but it's not for a home. That changed, and there's rules and regulations about mortgages. You have to actually prove you can pay it back. And as a result, you have to show your debt to income ratios. So for the first time, I mean, I don't want to say for the first time, but this time around, the debt problem is not in real estate. Real estate is solid. The people who have loans in real estate qualified for them. And if you look closely at the FICO scores, the credit scores of the people who got loans, they're very high. There's very few subprime loans out there, although a lot of people would like to worry about that and tell me there's a lot of stated income loans. There's a tiny, tiny bit of that happening, but for the most part, it's really hard to get a loan. You really have to qualify, and it's very much open book. I mean, Rich and I were just trying to get a loan the other day, and it was like the things that they were asking for. It was unbelievable. It was unbelievable when we've got really good credit and everything that they would want, but still they were asking for the most ridiculous things. So again, it's difficult to qualify for a loan, and people who have loans are locked into really low rates, especially if they bought homes in the past 10 years. They bought the homes cheap. They're locked into low mortgage payments. Rents are way higher than most people's mortgage payments if they got them, over the last 10 years. So even if they lost their job or even if they had trouble making those payments, most are going to find a way to stay because they have equity and they have low payments. If they lost their house, they're just going to have to go rent somewhere else and pay more to do that. So, again, I don't think there's a problem. It's not the housing market that's the problem this time. It's other debt. So, again, what will these people be renting since many will not be able to buy a home? Well, this slide comes from John Burns Real Estate Consulting. He is brilliant. That company basically advises builders on where to locate, or where to build homes, and how to do it, and where the demand is. They consult with Real Wealth Network on our syndications and the different, definitely the Tampa deal where we bought those 4,200 lots in the downturn for 10 cents on the dollar. It's a huge project though, so we've been getting consulting from them. So they have a ton of data and it's wonderful. Here's some of the things that basically they said is that the demand for rental housing will be, it's about 16 million in single family and 28 million in multifamily. So lots of demand for both. The multifamily households have a bit lower income than the single family. They tend to be more transient too. It's one of the reasons I love single family is that you can, lock in your fixed rate mortgage, 30-year fixed rate mortgage up to 10 loans. You have a kind of a family that has a higher income and is more apt to stay there and potentially, raise their kids and so forth. Whereas multifamily, they tend to be lower income, and lower income tends to be more mobile. They might get transferred more with their job. So almost 20% of America now rents almost 12% of America now rents a single family home. Again, you've got this massive group of millennials forming households. The largest group forming households are young people, right? Because they're going to college and they get out and then they get for the first place. And a lot of them have pets and they want a yard. So, we're seeing household formation, but a lot of that formation is wanting a single family home with a yard, either that or an apartment that has, a lot of facilities for that has parks and, pet areas, because pets are a big thing with the millennial generation. So where would you want to buy the rental property if you want to take advantage of this growing demand for rental property? I love the slide again from John Burns Real Estate Consulting that shows that projected household growth, this is household growth by region in the millions from 2016 through the next decade, will be 5.3 million more homeowners. So lots of people will still be buying homes, but even more people will be renting, 7.2 million more renters. And obviously the question we want to know is where are they going? We want to provide those houses for them, right? Where the greatest demand is. And it is so fascinating that the number one biggest growth area is going to be the Southeast. And oddly enough, Florida is not included in the Southeast. I don't know why. I guess it gets its own column A huge amount moving to Florida as well. So when you combine Florida and the Southeast, maybe they just couldn't fit that on the slide. So they had to separate it. So huge growth. And then add Texas on there too. So why this growth to this area? What's driving it? Well, of course, jobs are, but even more importantly, it's most likely, the affordability, they're warm areas, but mostly the affordability that there's no state income tax in Florida and Texas, and it's low state income tax in some of the other states down there. And they're very job friendly. So a lot of jobs are moving to those areas. So it's a great place to buy a home for, like I said, under $200,000, rent it out, it'll cash flow. And with so much growth, eventually these people are going to deal with their debt, they're going to pay it off, and they're going to want to buy a home, and that home might be yours. You can rent it, cash flow it, and someday sell it, most likely for a higher price, especially given what I said earlier, that the cost to build a home continues to rise. You lock it in today's cost, and you get all the upside. So a lot of times people come to me and say, well, what about the Northwest? Oregon and Washington. Well, I think this is an important slide to show why we don't have teams up there. In the Northwest, it's just not where the households are going. There's some growth, but not nearly the growth elsewhere. Plus, the home prices are higher, the cash flow is lower. Now, we have a syndication. We're building homes in Bozeman, Montana, and that's different because there's a lot of wealth moving there and a massive shortage of homes. So, we're building homes and selling them retail, but not holding them for rental in those areas. It just doesn't make sense. Here's the job expansion, and you can see um, Austin, Nashville, Dallas, San Antonio, Orlando, Denver. I mean, some of the cities, Houston at the top. And then you look down, you can see Los Angeles, Orange County, Sacramento down at the bottom. So it's, again, one of the reasons why we choose the markets that we choose. So what do you do? What do you do with this scenario? I'm showing you this slide because I think it's really important to understand that whenever I'm asked to be on national news stations, TV or radio, they always ask me, how's the housing market? And I always have to respond saying there is no housing market. There's just a whole lot of markets doing different things. You got to know and understand the different markets and where the demographic trends are going. Try to get there before anybody else. Go where it's cheap and where there's growth, and you'll probably benefit. You'll get cash flow today and probably appreciation later. So this slide, I've showed it to you before, and I'm going to show it to you again because I think it's a great slide. This shows the home price appreciation in the U.S., the average home price appreciation. And the red one is average home price appreciation in Texas. So back in 2004 was the year that pretty much peaked when prices went to their highest. California was like, I think the median price was like 500, so it was up here. So back then, if you said, how's the U.S. housing market? You'd have to say, well, it depends, right? Because California was red hot. It took 100% of your salary to be able to own a home. And the only way to get around that was to have stated income loans and lie about the ability to qualify. I mean, there was just no way to qualify because home prices were way out of line. So that's why we had the liar loans. You look at the U.S. in general, it peaked around 270 or something. And then in Texas, look at that, boring, boring, boring. The median home price looks like it was right around 150. So a lot of people, I learned on the Real Wealth show when interviewing Robert Kiyosaki right about this time. He said, oh, this is an amazing time to sell California here at the peak and buy in Texas at the trough. It just had not bubbled because they had very different lending laws. They're very, very strict. They'd gotten absolutely hammered by the S&L crisis, and they reorganized and said, we're not going to do crazy loans. So you couldn't do 125% mortgages. CLTV is what it was called, combined loan to value. I don't even know if we have that today, but it was real common back then, where you could have 100% financing on your property, but then you could get another loan on top of that, CLTV, combined loan to value. You could get a second lien that was 25% over the value of the property. Craziness. And you could do cash out refinance, get that extra money to pay for repairs and and like furniture, but no one did. They just spent it on vacations or whatever. So you could go over the value of the property in borrowing. Well, Texas was like, no way. You couldn't take out more than 80%. And as a lender at the time, we hated doing loans in Texas because they were so strict. But as a result, they did not bubble and their loans were solid. So Kiyosaki saw that, and he saw that Texas at the same time was trying to recover from the S&L crisis. So they made it a very job friendly environment, offering all kinds of tax incentives for business to move there and move their headquarters. And if they did, they could pay people less, and those people could live better. They could have nicer homes, and their money could go further because it was so affordable in Texas. So at that time, you had this crazy opportunity to sell your overpriced property and exchange it for cheap property in a growing market, a market that hadn't shown growth yet, but the metrics showed growth. It showed that there's all this job growth, there's all this population growth. Eventually, prices are going to go up. So I listened. Rich and I went and refinanced our house and went to Dallas for the weekend and came back with 5 homes, brand new homes between 120 and 140,000 dollars that rented for 1,200 to 1,400 dollars a month. It was like it was crazy. It made so much sense. So I talked about it on the show, on the Real Wealth show, and suddenly, we had all these other people saying, "Oh, I want to do that too." And that was kind of how Real Wealth grew. Is we shared our referral. We shared our basically our network with our members. Like, these are the people we use. This is the agent we use. This is the property manager we use. If we all sort of use them, then maybe we'll get a better deal on property management. Maybe they'll pay better attention to us. That's basically how it all started. And so then more and more of our members did that. They sold at the peak, bought in Texas at the trough. And those who did, well, they got to triple their cash flow, and then since then tripled their equity. And if they put very little down, it's infinity what they got out of that. If they only put, there were some people who could put zero down back then, but even today, if you put 20% down and the house value triples, you've really increased, doubled, tripled, quadrupled your equity, at least the cash that you put into the property, while having someone else pay down the loan and quintupling your cash flow that you would have gotten in California, because California had cash flow in 2004. It was just of the negative variety. It was negative cash flow. So you could go from negative to positive. And the people who sold their properties at the peak, well, those properties were cut in half during the recession, even lower. Even some were down 25% down 75% to 25% of their former value. So again, at the last expansion, at the peak of the last boom, people had this amazing opportunity to reposition their assets, but no one was talking about it. We were talking about it on the Real Wealth show because I had the awesome opportunity to interview people like Robert Kiyosaki, and I have that opportunity today still to share that information with you. But we have that again today because prices are back up here. But there's areas in the country that haven't peaked, and that's the opportunity. So I share this slide because so often we want to give our power away to somebody else and say, so and so knows more than me. These reporters must know more than me. Look at this headline news. In this case, back in 2012, right around here, I was asked to debate Robert Shiller on Fox News. And his perspective was it was a very dangerous time to buy real estate. And my perspective was it's the best time ever. It's the greatest transfer of wealth ever. And if you were a data person like Robert Shiller, uh, you might have just been looking at the data, and you'd be right. You'd be like, wow, real estate tanked. Why would you buy it? Right? Whereas if you looked at these numbers and you were just looking at data, you'd say, oh, yeah, keep buying. Look at that curve. What if you're not looking forward, though? None of it matters because things can turn on a dime. Look at that. If you were right here, you'd be like, oh, let's keep buying. And a lot of people bought here. And this happened. And a lot of people here might have said, oh, I'm never buying that. But those who saw the opportunity, look what they got. So you have to be able to look forward. So in the interview, again, what I'm trying to say is that even Robert Shiller of the Case-Shiller Index was only looking at the data. versus what's coming. So we have to use our common sense. And on this show, I was terrified. I have a San Francisco State degree in broadcasting. I'm no Yale student, right? This was San Francisco State versus Yale. I was terrified to be on this interview, but what I knew was that we had an opportunity of a lifetime to lock in for 30 years, the lowest rates in history, when home prices had tanked and the mortgage was sometimes 200 or 300 bucks when the rent was sometimes 800 to $1,200. Like it, how could it not make sense? So again, use your common sense versus what other people, so-called experts, will tell you. Uh, Now, Goldman Sachs at the time, they're more perhaps forward thinking, although they maybe not so much during this boom, but they uh, they saw that we were coming in and bringing investors into these foreclosed markets, these boring markets like Texas, and they saw that we were going in and bringing investors into areas that were on the precipice of booming, and it was helping not only the neighborhoods and the people in those neighborhoods, but helping the investors. So at the same time that I was being challenged on my beliefs, I was also being awarded. Again, be careful because I won this top 100 most intriguing entrepreneurs 2 years in a row for the work we were doing, bringing in investors into neighborhoods that no one really wanted to touch. Um, so I just share that because it's just important to, again, trust your gut. Don't don't base your future decisions on past data. You've got to see where the puck is going. All right, so let's talk about that. All right. There's a lot of people, there are rooms full of people who want to do multifamily. I'm sure a bunch of people on this call today are wanting to do multifamily, and I don't blame you. Multifamily is great. I mean, who wouldn't want 200 units under one roof instead of one unit under one roof? Who wouldn't want one loan for those 200 units versus one loan when you only get 10 on one house? I mean, there's a whole lot of reasons why multifamily can be great, but don't fall for the idea that it's great all the time or anytime or no matter what. And that's the problem. Is a lot of the things that people are saying it's all true. Multifamily can be great if you do it right and if you time it right and if you understand what's coming. So there's some really scary multifamily deals out there. And the scariest thing is the people who are teaching a lot of these multifamily boot camps that are packed full are people who've only been doing it for a few years. And I run into people all the time who have raised millions of dollars from investors on their first multifamily deal or their second, or they've only been in the business for a few years and don't know anything other than an expanding market. It's akin to the slide I show you where everybody kind of jumps in at the peak. So last week, or let's see, 2 weeks ago, Rich and I got to spend July 4th with Ken McElroy. And I know I put that in the newsletter, so you've probably already seen it. And this is the kind of person you want to get your information from, somebody who's a master, somebody who's been doing it for years. He's owned 10,000 doors. I mean, he's been through the ups and the downs. This is the person you want to find out, what are they doing? That's what's been the benefit of the Real Wealth shows. I've been able to interview these kinds of people and share that information with you. Back with Kiyosaki, and by the way, Ken McElroy is an advisor to Rich Dad Poor Dad, to Kiyosaki. So I just interviewed him for the Real Wealth show. That's what this picture is, and that show is going to be coming out soon. I don't have it yet up and posted, but it will be soon. I can just summarize what he said. And some of the things to be aware of in multifamily is that there's certain cities that have an oversupply of Class A, because a lot of people came in, a lot of builders came in and built Class A, but they couldn't do it for cheap, so it's expensive, and a lot of those units are sitting vacant. How's that going to affect B and C class properties? Well, if there's too much of an oversupply of Class A and those rents have to go down, well, that's going to affect the other classes. Class B might have to go down as well to compete along with Class C. But if you want to be safe, perhaps Class B is where you want to be, because you could, if people can't afford the Class A, they might move into Class B during a recession. And if people have been in Class C, but rents go down, well, they might have the opportunity to move up to Class B. So just be aware that there's changes coming. You need to understand that this was the biggest thing Ken said. He sold the bottom half of his portfolio, the bottom 10%, the stuff that really wasn't performing. They'd already renovated it. They'd already tried to push rents. You can only push rents so far. Someone can bring you a pro forma and say, hey, we're going to fix this building and raise rents. Well, what if no one can afford those higher rents? So you've got to really make sure you understand if the market can handle a rental push. Because if it can't, you can do all the renovation you want, but you may not get more money for it. So if the whole area starts to see rents decline, then you start to see cap rates go up. And basically what Ken was saying is, well, this was a really great time to reposition his assets. That's what I'm saying to everyone. This is a good time to look at your portfolio and reposition. So what he did, he came together with his team and looked at the least performing properties and sold them, but didn't just put them on the market. He put them on the market for the highest price. It was kind of like he put his lowest performing properties on the market for what would be the highest price, like almost an A-class property, but they weren't. But guess what? People bought them. And he kind of was privy to what the people who bought them were telling their investors, which was basically, hey, we're going to improve these units and push up rents. And well, that had already been done and it didn't work. I mean, like Ken McElroy's not going to try that, Of course he did. So anyway, if that happens, cap rates go up, somebody paid too much for the property, too low a cap rate. If rents go down and cap rates go up, then oftentimes the bank will say there's insufficient security. Because in the same way that multifamily is so fabulous, if you improve it and raise rents, the value goes up exponentially. The same is true for the opposite. If rents go down, then the value goes down exponentially. And oftentimes the banks will say, hey, there's not enough equity. You need to put more money in, put more equity in, insufficient security. Make sure you understand that clause. And if that clause is in any loan documents, you want to make sure you understand it so you aren't forced to repay the loan. And then make sure there's no due for no reason clauses. Multifamily loans are very different. Commercial loans are different than our little Fannie Mae, Freddie Mac fixed rate mortgages where you lock in the loan and it's just single family loans are different because they're really there to protect the consumer. There's not as much protection for the investor. And it's, again, important for you to know. Commercial loans are investor loans. Too many of these deals are ridiculously over leveraged. You do not want to be over leveraged at this time in the market. This is a time in the market where we don't know what's coming. We don't know. There could be a recession in 2 to 3 years. So you don't want to be over leveraged. Just be very cautious about that. At Real Wealth Network, we're going to stick around 60 to 65% if we do any multifamily deals. Low reserves. You got to have a lot of reserves when we're moving into this phase of the cycle. And perform your stress test. I just had someone bring me another deal that was only accounting for rents rising and prices going up. That's not a stress test. A stress test would be, what if rents don't go up? What if they just stay stable? Or worse, what if they decline? Can we still hold this property in that case? That's a stress test. So in summary, what are we doing? Well, the economy appears to be strong right now, but it always looks strong before a recession. So don't let it fool you. Just go look at the charts. It always looks strong before a recession. There's always low employment. There's always a booming market. That's the pattern. So it's also fragile. We don't know how much longer the expansion is going to go. It could go longer. It could not. So we know it's the longest expansion, but not the largest. So how much further can it go? The fact that the Fed is wanting to hold rates, or even there's more talk about lowering them, well, that's exciting because that's a stimulus. The Fed has been tightening. That's the opposite of stimulus. It's a tightening measure to slow down the boom, and it worked. Now they're reversing that and they're lowering rates, or they're talking about it, and that would be a stimulus. But when everybody's saying the economy is booming and we're at the end of an expansion, why on earth would you lower rates? It doesn't make sense. It doesn't make sense. So either someone's lying to us somewhere. Either the economy isn't as strong as we've been told, or we're just trying something new and we're going to stimulate at the top of an expansion, and just try to avoid a recession altogether. Is that possible? So it's just this, we haven't been in this territory before. So again, the reason why you've got to reposition, batten down the hatches, do the things I said, keep low leverage, just, be careful out there. The pension and debt crisis is looming. I think that's not really going to hit for a while, but it's something important to think about. And another good reason to have your own pension plan in place. And one of the ways to do that is through affordable real estate, cash flow real estate. And again, that affordable housing is in low supply and high demand. So if you can get your hands on affordable housing, it's probably going to be in high demand for a while, probably at least for the next 10 years, because you just can't build it. But we can do what many can't do. Like the hedge funds can't necessarily go in and do these fixes. And, we have a team where they go find these deals. It's hard to find the deals, but they've got the teams to fix it. And they can bring those properties in at an affordable level. And that's amazing. There's a low supply of it and there's high demand. So that's really the exciting news for us, those of us who want to buy rental properties. And then again, the growth is headed to the southeast. That's good to know. That does not mean by any means that we don't like the northeast. We do. It's a beautiful balance. In our own fund, we have a single family rental fund. So we are owners right along with you. We are testing the market right along with you. We're going to share everything that we know so that we can all benefit. And what we did in our fund was we bought a bunch of properties in the Southwest because we know where the growth is. But it's not going to be as high cash flow as the Northeast. So we balanced it. We bought a bunch of properties that are super high cash flow in Cleveland and Detroit and Cincinnati and Kansas City and some of these areas that are still really low home prices but super high cash flow. We balanced it with a bunch of properties in the high growth markets where there's maybe not as much cash flow. So that way we're diversified, we're getting a little bit of everything, and having the cash flow to kind of cover, but also in these growth markets. Again, reposition assets for protection. I can't tell you how many times I will give this speech and I will have someone run up to me at the end and say, oh my gosh, I never thought of it this way. I just bought a house. Again, I'm coming from California mindset, but it's like, I just bought a house. It was $1 million. It makes $3,000 rent. Was that bad? It's like, it's not bad per se, but you've got $1 million property that is in one location. It very well could be on a fault line. Bet you don't have earthquake insurance. If you do, bet you're not making any money because there's no cash flow when you have earthquake insurance. And you got all your eggs in one basket. What if there's a vacancy? What if, in California, someone can it's very easy to stay in that property and not pay rent. You could file bankruptcy. It's harder. These are tenant-friendly laws here in California. So what if your person just stops paying rent? It could take you 6 months to get them out. However, what if you took that $1 million property and repositioned it and instead bought 10 properties, maybe 5 in the Northeast and 5 in the Southeast? So you've got some growth properties and some cash flow properties. Now let's say there's a hurricane and a couple of your properties were affected. You did not buy in flood zones. Don't buy in flood zones. You did not, but you still had flood insurance. So that was covered. The flood insurance isn't that expensive when you're not in a flood zone. So meanwhile, maybe your 8 or 9 other properties are doing just fine. You still got all the cash flow from those properties because you diversified, and you're not going to really feel that one little problem. Whereas you'd really feel that one problem if you only had one asset. So again, repositioning your assets, buttoning down the hatches, this is the time to do it. Just like 10 years, well, gosh, been 15 years ago now when we were advising people to sell at the peak in California in 2004, 2005, sell, and exchange that one property into 5 or 10 or 20 or whatever, diversify so that you can kind of handle whatever's coming. And when we know that there's all this demand for housing, for affordable housing, even in a recession, there's probably going to be demand for it because people do like to live indoors, even during a recession. Okay, now I just want to share this slide. Here's the apartment market cycle forecast. Really, again, important to understand that in a lot of the markets we're in phase 3 in hypersupply. You could see that where the next phase would be recession. And a lot of these markets are real close to that. And that's in apartments. This does not necessarily apply to single family. So just again, be cautious, be aware, make sure if you invest in anybody's multifamily deal that you know that they have a little gray hair, that they've been through a downturn and they know what's coming and they know how to prepare for it. Depending on someone who's only looked at the last 10 years is not going to be helpful. Now, this is Rich and me at our latest development, or one of our syndications in Reno, Quest at Meridian 120. It was the open house. I know a lot of you were there. It was a great event. And, we're selling homes up there. And these Quest homes are selling pretty quickly because they're really in the affordable range for the area. And that was it. I just want to explain the way that this was done so that you could kind of see how Real Wealth Network is moving forward with syndications in a really safe way. So that, and safe isn't really a word I'm supposed to use according to the SEC, but in a cautious way. Let's say it that way. When we bought the land, we brought a group like that, like this tour, look at the land, and it's just raw land. So it's like, what are we going to do with this? But of course, before we syndicate it, we want to make sure that the entitlements are in place and that the city wants us to build houses there, that we've got the approvals to do so. So with Quest, we were able to acquire the entitled land from someone else who was in a distressed situation. They'd taken on a hard money loan, and that debt's usually what takes people down. They were in some bad debt. So we were able to buy the land for the price of raw land when it was actually entitled land. So really amazing opportunity. We raised enough money to buy it all cash and then to build the first phase and then use that first phase of homes being built to fund the second phase and so forth. So this way we didn't take on any bank financing. Because when building homes, if you take on bank financing, those loans are big. These aren't little loans, they're big loans. And if you're not able to keep up with the demand, then at least in the US, the bank is forced to foreclose on you if you can't make the payment. And it's not like you can just take out your wallet and make the payment. These are big payments. So you have to sell a certain number of homes to be able to make the payment. If you can't make the payment because there's a slowdown in the market, well, then you get foreclosed on. And that's what happened in 2009. That's why there were so many builders that just got wiped out because they had loans. So instead, we syndicated, we raised enough money to buy the land with cash to build the first phase with that cash, sell those homes, and use that money to build the next phase. So it really keeps us in a secure position there. That's how we're able to move forward and offer those investors a 15% preferred return. So again, if you want to know anything about our future syndications, you need to make sure you're a member of Real Wealth Network and that you filled out the investor form. That'll open up that part of our website that will tell you all about our future syndications, but otherwise you won't be able to see it. And then, of course, just want to make sure that you've subscribed to either the Real Wealth Show or Real Estate News, because that's a show I do regularly. The Real Wealth Show is where I interview people who have experience and can share their wisdom with us. The Real Estate News is where we give daily updates to just kind of keep everybody on top of the changing market. And I think that is it. So I could go through the questions now. And the first one says, a good book on the Federal Reserve and how it was created is The Creature from Jekyll Island. Agreed. That book is amazing. It's a big book, but I couldn't put it down. Got the awesome opportunity to meet the author. He's the coolest. Love him. Just wonderful man. So yes. And are you doing any more SFR funds? We are discussing it. Yes, we are discussing it. I know our team would really like to do it. We just want to make sure that it's the right move. But I do want to let you know it would be a lower preferred return than our construction deals, because I think it's going to be lower. It's going to be 5 or 6%. So if that sounds good to you, then let us know. We'll probably send out a test to see who's interested. The investors would also get the depreciation benefits, but we have to, if we do a fund, we have to have a manager managing that fund, and that manager needs a fee for that. And then we have to take care of all the accounting and the legal. So there's fees we have to add when we do the fund. So the good news is we do the work for you. The bad news is we have to charge for that. And so the return can be a little lower. But if that sounds good to you, and then we split the profit at the end on the appreciation. And we have all the teams set up. Our teams would love us to do it. A lot of our members would like to do it. We just need to make sure it makes financial sense for Real Wealth Network to do it. And that means charging fees, and make sure you're okay with that. But we will let you know. But like I said, I would definitely look into our other syndications because those pay a little more. In fact, we've got I think it's a 16% for lenders on our Costa Rica project, higher than that for the equity partners, and for other syndications we usually do about a 15% preferred. So that's pretty good. It's just that you get taxed differently than if we have a rental fund. So I know why people would like to do that. Unfortunately, you can't 1031 exchange into a fund, and we haven't been able to figure a way around that because we know that a lot of our members would love to 1031 into one of our funds and just be totally passive, but can't figure it out yet. All right, so can you talk about Costa Rica? Yeah, it's a great way to diversify. I can't I guess recommend it enough to look into it. It's a unique project. We're still raising, but we're still accepting investor dollars, but we have 4 big investors that would like to come in, and all of that is going to be happening in the next few months. So there's kind of a limited window of opportunity to get into that. If you want to find out more, you can just go on our website, realwealthnetwork.com, and look at the webinars there. And also on the group investment page, you can get the PPM and the operating agreement. It's for accredited investors only because we filed it as a crowd-funded project, which means we can talk about it publicly, but only accredited investors can invest in it. So, and all those details are on our website. All of our private placements we can't talk about publicly, which is why you have to be a member to be able to find out about those and fill out the investor form. But yes, Costa Rica it's a good way to diversify just a little bit of your portfolio into that. Do you recommend selling your primary residence in California or even buying one? You know, I look at your primary residence, as does Kiyosaki, as separate than an investment. Because, like my daughter, she's 27, she's pregnant, she's her family's starting. She's going to be living wherever she lives for a long time. And so it shouldn't be so much an investment decision versus I want to live here and I can afford to live here and I'm going to stay here a long time. And if you stay there a long time, you're probably going to make money on that home. Not a guarantee, but probably. So, if you're going to live there and raise your family there and never leave, then don't worry about it. But if you are thinking, I'm going to buy this house because I'm going to make a bunch of money on it, I would think of it differently than as an investment. I would look at it as, I really want to live in this area. If I buy it, I have to put this much money down and the mortgage is going to be this much. If I rent it, it's going to cost me this much. What's the better deal? If you can get a 4% or 3% down payment on an FHA loan and buy your primary residence, you barely put any money into it, and your mortgage is the same as rent, why on earth would you not do that? I begged my daughter, based on the discussion that I discussed earlier about kids getting in debt. She told me, Mom, I just found out I have really good credit. I know you've heard this, some of you have heard this story, but I'm going to tell it again. I was visiting her one day and she goes, Mom, turns out I have really good credit. I want to buy a new car. And she just gotten a new job and was making a bunch of money. And she was a yuppie and like, hey, I want to buy a fancy car. She was driving the car that she got from college. It's a little, she still has it today, but it's this little Scion, this dumpy car from 2006. And I said, honey, before you look into buying that car, your car works. It's just not fancy. It's not impressive. But you know what's going to be more impressive than a new car is if you were a homeowner. So I said, just go talk to a lender and see if you qualify. Turns out they were blown away by her credit too. And she had saved $10,000. I couldn't believe it. I was so proud of her. She was only 23 or 24. And she, so they said, yeah, you get a 3% down loan. And they set up to a $300,000 house because she lived in Chico, California. And she was going to school up there and then got a job with Build.com. And so then it turns out that payment on that home would be less than she was paying in rent. And she was renting a 2-bedroom home. She could buy a 3-bedroom house. So she did it. Well, as you know, the fires happened in Paradise. An entire town was wiped out. That house is one of few remaining houses in the area, and the insurance companies are willing to pay more than double, almost triple what her mortgage is. And the value has gone up substantially, probably at least $100,000 in the time. I'm giving away all her secrets, but that's amazing. Isn't that such a better deal? Have all that cash flow from that house than having bought a car. But so the bottom line is, if it makes sense to buy the house, buy it. If you're going to live in it, if you really want to live in an area and it's cheaper to rent, then rent and use the money you would use for a down payment to use on buying investment property nationwide. I guarantee you will cash flow enough to more than cover the rent where you are. But this way you're diversified. You can take all those write-offs. You can live wherever you want. You don't have to live in a dumpy home. You can live in your dream home and just use the rental income on your rental properties to cover it. So yeah, that was my very long answer. So if you already own a home, it's gone up a lot in value, it's your primary residence, you're thinking about possibly moving, this could be a good time to do it. If you're planning on staying there, just stay. All right, if you were to buy a single family rental today, which cities would be the best weather to weather the coming storm? All of the properties on our website, I'm sorry, all of the metro areas on our website are areas that we think are great and have strong potential. As I mentioned on the slides here, this kind of answers that question. The Southeast, Texas, Florida, balanced with properties in the Midwest. So not as much growth, but higher cash flow. So you get your growth properties and lower cash flow in the Southeast, and then you balance it out with higher cash flow from the Northeast. I hope that helps. But anything on our website will give you the metrics on why we like those areas. Could you comment on the plan for real estate notes? If you're interested in notes, there's a lot of books on that. My friend Dave Van Horn wrote a book on it. I think something about note investing. Forget the title. Notes within our company, if you clicked on interest on that, you'll get an email today on the details. If you didn't click on it, just reach out to info@realwealthnetwork.com and we'll make sure you get the info. Do you have any charts showing how rents on single family homes decline in a recession in the Southeast location? Ooh, I will get that. Jill, if you can take a note, let's find that chart. What thresholds would you look for when investing in California at this time? I don't like California. I don't invest here. It's horrible. How is that for an answer? The landlord laws are just horrible. I mean, if you like rent control and you like people being able to stay in your property without paying rent, then invest here. I'm sure there's lots of people who disagree with me, but I know a lot of landlords who are selling everything they have in California and getting out because of the crazy laws today. But if I were to buy something, I mean, obviously the Chico area, I have a property in Chico that's incredible. If anybody is interested, I have to sell it because I'm going to help my daughter buy a house in Southern California because I want her down here and she's going to rent out her one up there. So anyway, Chico, I think we paid $320,000 and it rents for $3,000. So that's an area that there's going to be strong demand because a whole town disappeared. I would probably look in that region or Sacramento, maybe the Inland Empire. If you're going to buy in higher priced markets, you might look at Airbnb. But Airbnb laws are crazy right now and changing on a daily basis. So, we're not doing business in California. It's just really tough to do. What do you think about, there we go. Next question. Inland Empire, still pretty good. Riverside, Visalia, sure. Fresno, yep. Do you prefer to get fixed term HELOC loan and buy investment properties in 2019? Sure. Yeah. Anytime you can get low cost debt and invest it for a higher return, you're going to get the lowest cost debt on your primary. So refinancing and doing a cash out refi, whether it's through a cash out refi or a HELOC, you can lock in that low rate and invest it somewhere else for a higher return. That's not a bad plan. But you don't want to lose your money because that's your nest egg. So make sure you really do your homework before you buy anything, do anything with that. Buy the right property. What do you think about raising of the minimum wage approved today? It's just part of inflation. Inflation. You know what happens when there's inflation? You're really, really happy you own assets. And you're really, really happy you got debt on those assets, because when we've got inflation, that's all it is. It's just paying people more, which means who's going to cover the cost of that? We are, as the consumer. That's inflation. So when these types of inflationary things happen, you want to buy as much real estate as you can, because you could be pretty well assured that we're going to see prices go up. And when there's inflation, debt becomes smaller. So people are getting paid more. There's more money circulating. The debt you have feels like less. So really good to take on this low cost debt, buy a bunch of assets, watch those assets grow in value while the debt decreases. 2 homes in Palm Springs, approximately 400,000 each. Renters pay the mortgage, hold or reinvest. I'd need to know how much you're getting in rent on that. Can brand new homes be a cash flow market? If you buy the right home, yeah. We've got teams in Florida, North Carolina, Atlanta who sell new homes. And it's not going to be the highest cash flow in the world. You're buying a new home. It's going to be higher priced, but I love new homes. They just, it's new. So you have kind of less maintenance. That kind of balances out the lower cash flow, except that a lot of our teams also renovate homes. So that's nice too. But if you're going to buy a bunch of new homes, then you might want to offset that with some cheaper homes in cheaper markets with higher cash flow. Short-term rentals got shut down on the Monterey Peninsula this year. Yeah, exactly. So many. Don't buy a property thinking you can short-term rental it, because you might not be able to. Are you following defaults, pre-foreclosures? Yeah, it's really low. At least the data I see. Foreclosures are very low. $2,000. Oh, if you're getting $2,000 on a $400,000 property, you could double your cash flow investing elsewhere. Just with a quick glance, you could go from getting $4,000 a month to $8,000 a month if you invest elsewhere. That's just my opinion. Do you foresee real estate prices going down during the recession? Yeah, they already are. San Jose, California, I think prices just went down 4% this past year. It was the San Francisco Bay Area is the biggest bubble in the US, and that's common knowledge. Prices are way beyond the ability for people to pay them. So we've been expecting prices to slow down there, and they have. Sales were down, I don't know, 17%, and prices down 4%. I think that's going to continue if we see any kind of stock market readjustment. It's going to affect the high price markets, because it's the high price markets where people live who invest in the stock market. But if you're in the Midwest and you're in some small town there, your neighbors are not necessarily stock market investors. They're not going to feel it. So, it's the high price markets that will correct during a recession. The affordable markets rarely feel it. Again, it depends on the market. Would you buy a single family rental now or wait till a downturn in price? I would position myself where the growth is going based on this slide, and buy affordable properties in growth markets. That's what we did 10 years ago. We sold our high priced markets, and again, to reiterate, we did this, and we helped thousands of people do this. We help people sell at the peak in California and buy at the trough. These are still single family rentals, but they would sell one single family in California and exchange it for, say, I don't know, whatever, 5 or 10 in Texas. I'll give this story again so that you really hear it, because it's important. I had a woman come to me in 2005 who had 3 properties in Stockton that were $400,000 each, and she was getting $1,200 rent on them. She was desperate to retire. She hated her job. She bought the properties to retire, and they were nothing but a headache, just being nickeled and dimed. They were old houses in bad parts of town. It was a nightmare. She heard me on the radio and she said, help. So she came in. I said, I'll tell you what, it's a booming market. People are buying anything. They're not thinking about what they're buying. You could sell those for top dollar, those horrible properties, sell them for top dollar. I'll help you exchange them into brand new properties in the Texas area, in a really up and coming area where a new freeway's coming in and there's all this development and all these new jobs, but home prices are cheap. So she listened. She sold her 3 properties in Stockton for $400,000 each. We got her into 9 brand new homes in Rockwall, Texas, in that area for between $120,000 and $140,000 each. They each rented for $1,200. So now she had quadrupled her cash flow. 18 months later, the houses she sold in Stockton were worth $75,000 each. Remember, she sold them for $400,000 before. The person who bought them ended up with an asset worth $75,000 each. In Stockton, the area that got hit the hardest, because where the bubble goes the biggest, it falls the hardest and pops the biggest. So she completely repositioned herself, sold those properties, bought in Texas. They were still single family homes, but different markets behave differently during recessions. So as a result, those properties in Rockwall, Texas are worth between $300,000 and $400,000 today. Remember, she paid about $120,000 to $140,000. She never felt the recession. She never felt the recession because she battened down the hatches. She sold the high-priced, underperforming asset and bought low-priced, high-performing assets in growth markets. Would you sell a 12-unit in Cincinnati right now? We bought for 2.5 years ago. I mean, Cincinnati's a great market. I don't know that I would rush to buy it. I have to see the numbers. If it's performing and you're happy with it, I don't see a reason to sell it unless you can get a stupid price for it, because people are really paying too much for things. So you could always put it on the market and see if someone pays too much. But if it's cash flowing and you're happy, that's a good market, and I don't really see a reason to sell it, but I'd have to see the numbers. I'm trying to buy my first rental. What market would you start with? Whew. I suggest you come to our Cleveland event on August 10th. August 10th, we have an event in Cleveland, Ohio, where all 15 affiliates of ours from 15 different markets are coming to give highlights of their markets and highlights of properties available, and you could meet them all at once. You get a property tour of Cleveland and a property tour of Detroit if you want the next day. But it's a really great way to just kind of meet everybody and learn about all the markets. It'll be a long day, but it'll be fun. That'll be a great thing. If you can't come to that, just come to our events or watch the webinars on our website, or every week we do new webinars. They're all good markets. Make sure you have an investment counselor at Real Wealth Network. They can go over it too, because, it depends on what you're looking for. If you're looking for growth, if you're looking for a new home, if you're looking for high cash flow, price point matters. So I can't answer that question, but talk to one of our investment counselors and they'll be able to ask you a bunch of questions so they can point you in the right direction. Idaho. Idaho's growing. Rich and I bought 3 properties in Idaho during the last boom cycle. At the time, there were only 3 employers. After the recession, there was 1 employer. That's why we love growth markets, where there's a real variety of employers. So we got really hurt in Idaho. We paid too much for the property. Our tenants lost their jobs because the employers left, and we were just kind of stuck with 3 properties that weren't performing. So for us, I would be careful of Idaho, but just look and see what the job diversification is and the employer diversification. Make sure that it's really a growth market and that you're really cash flowing. I haven't really seen necessarily the numbers work. How do you view markets ABC price per rents? You invest in 5 units or under. Everyone has a different definition for A, B, and C. Some people will say that A is basically newer, B is less new, and C is an old property that has a lot of problems. Other people will say that A is in a more desirable neighborhood, B is in a middle class neighborhood, and C is in a lower class neighborhood, and D is in a high crime neighborhood. So, there's really no official definition, but what I love about, say, Detroit is the home prices are so low there that you can go into an A market, go into like the nicest part of town, and it's still going to be the cost of like a D property somewhere else, So you could pay $100,000, $120,000 for a super nice high class property in Detroit and get a really good tenant in an A property. Or you could go to Atlanta, and a $120,000 property is going to be not maybe very nice because it's a more expensive neighborhood. So again, it just depends. But yes, we love 1 to 4 unit buildings because you can get conventional finance. You can lock in 10, 30 fixed year mortgages, 30-year fixed rate mortgages. We know rents are going up, and when you can lock in that rate for 30 years, that's really a recipe for building wealth. But that's not to say we don't like multifamily. It's just the multifamily attracts a different kind of tenant, as I mentioned in, let me find this slide, just a kind of a different type of tenant. Is Florida a high price market? Depends on where. Miami's really expensive, but the teams that we bring, Tampa and Jacksonville and Ocala, these markets are not that expensive. They're pretty cheap, under $200,000 for a new house. It's amazing. Where did the data come from on this slide? I'm not sure. Oh, the one with the apartments. I don't know. I need to ask my team. I was supposed to put it on there and we'll list it. This particular slide that I'm showing is John Burns Real Estate Investing or Consulting. Someone said, thanks for all you do. Oh, you're welcome. I just really appreciate our members and want to make sure you're getting the right information. And there's so much information out there that is incorrect, especially headline news. And having been in the news and contributed to that for so many years, I guess I'm just making up for it, trying to give real news. All right, awesome, thank you. Can high property taxes in Texas affect cash flow income? You know, I just did a story on the news show about potentially taxes coming down in Texas, which would be fabulous. Basically, I mentioned earlier that certain markets will start behaving like California because California has been a high price market since I was born, which was a long time ago. So, you know, it's never been cheap to buy property in California. So people have been complaining about it. Back when my parents bought a house in Menlo Park, you know, like the center of the Silicon Valley, I think they paid 50 grand, you know, and that was expensive then. So you know, it's always been a problem of affordability. So when there's a lack of affordability, the public starts to cry out, and they start to cry out for things that is going to make the problem worse because they don't understand. So they cry out for rent control, and all that does is get more landlords out of the business and less builders wanting to participate. And you know, but with the tax thing, this is one of the better things, is that in California, home prices would go up so rapidly that people who bought their home suddenly couldn't afford it in their retirement years because taxes had gone up so much. You know, the price of the home might have tripled in value, but it wasn't their fault, you know, and all of a sudden they were getting pushed out of their homes because their dream of a golden year retirement and having their home paid off was no longer good because property taxes were so high and assessed at a higher rate, out of their control. So California, you know, came along and said, all right, fine, we're going to limit the amount that the taxes can go up so that when you're old and retired, you can still live in your home, because that's the dream. So, you know, places like Texas are for the first time ever experiencing prices going up, and they're reevaluating this tax situation they have, which is crazy. They have way too high taxes. And now people are saying, enough. Home prices have gone up. These houses get assessed every year. It's not our fault that all these Californians are coming in and driving up prices. We shouldn't have to pay higher taxes. So anyway, I think there's going to be a shift there. Pay attention to it. But yeah, you have to be careful in Texas that taxes are high. Now, it depends on the neighborhood, and sometimes the cash flow is high enough to cover it. So, you know, I mean, like I said, Rich and I had like, I don't know, 14 homes in Dallas or something. I don't know. We had a lot of homes there, and weren't so worried about the taxes because the rents were high. So again, it just depends on the property. There are some doom and gloom people out there that talk about economic collapse. As an SFR investor, would you be concerned about a situation like that? Listen, if there's an economic collapse, your money, you know, there's no safe place for your money. You should be stocking, I don't know, alcohol or something that people will need in a recession. Cigarettes and alcohol and maybe some joints. But no, in all seriousness, if there's a massive economic collapse, you know, what are you going to do? Everyone is in the same boat at that point. At that point, Rich and I have already identified the mansion that we're going to break into and take over No, just kidding. There'll be a zombie apocalypse. But in all seriousness, if there's a really severe economic collapse, you just want to be as diversified as possible. Have a little bit of gold, a little bit of silver, have some property overseas, have some investments overseas, buy some bonds, maybe in another country that doesn't have high debt. You just diversify. But as far as single family rentals, like I said earlier, we had a horrible recession 10 years ago, right? I mean, one of the worst since the Great Depression. And many people lost everything. And the people who lost everything were the people who did not structure their portfolio properly. So I just realized I'm way over time and I apologize, but some of you are here with me still, so I'll just keep going. So it's a scary question, right? We know that there was a massive crash and people got hurt. Rich and I got really badly hurt. We bought 3 properties in Idaho that were overpriced and didn't cash flow in a market with 3 employers. Such a bad idea. But our properties in Texas really performed well. They never even felt the impact at all, at all. So why did we veer off from our plan to invest in an area that had low cost housing with high rents, high job growth, uh, massive employer base? Why would we veer from that and buy in Idaho? I don't know. I read a headline somewhere that said Idaho was growing, so we bought 3 properties there. It was dumb. I didn't think it through. So you just have to reposition properly. Another problem we made in 2008 is I was a mortgage broker, so I could write myself loans. It was so easy. I could get as many properties as I want. There was no limit. So we could just buy, 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 buy. So it was fun. It was exciting until it wasn't. But another thing we did was put deposit down on 3 properties in this little town, Seaverville, outside of Knoxville and Tennessee. And um, we got this construction loan and it ballooned after a year, but we would just refi into a regular loan. And once again, it was debt. It was debt that we had trouble with because we got a construction loan that ballooned in 1 year and we fully expected we would be able to refi into a new loan. Well, guess what? The mortgage market collapsed. No one would give us the loan because we had more than 10 mortgages, and Fannie Mae changed the rules and said, you can only have 10 loans. No one would give us those loans to refi out of the construction loan. We had to come up with $300,000 cash. No, I think it was like $500,000 cash to pay off those construction loans in the middle of the recession. So, when you're doing deals that have short-term financing where you'd have to refi out of it in 2 to 3 years, you're taking a risk because the financing may not be there for you. Don't take it for granted that it will be there for you. It might not be. So everything you do today needs to withstand the possibility of things changing dramatically. So, you lock in the 30-year fixed rate mortgage, you're good. You get into an adjustable fixed rate mortgage, you might have to refi, and that might be difficult, or rates might be up, or things might have changed. So, again, you can survive the next recession if you do things right. I'm going to come back to this slide to remind everyone what I think needs to happen. All right. Can I rewatch this video? Yes, it will be posted on our website. Thank you for being there. Thank you for listening. Where does John Byrne gets his data? Ooh, I don't know, but he's got lots of data. So you could check it out at John Byrne's Real Estate Consulting. He's online. Let's see. Thank you for your time. Oh, you're welcome. What are the age in the properties you purchased for renting? I don't worry too much about age. I just either I'm going to make sure that the renovations don't cost too much, or that it's been fully renovated, or that it's brand new is nice, but I still buy old properties too. So it just depends on the property. I just turned down a property because it just looked like it was going to be too much work to renovate. So just didn't want to, honestly, I just didn't feel like dealing with it. But anyway, that is that. All right. Thank you for staying so long. I have talked way too much, but I really appreciate you being here to listen. Have a wonderful rest of your day. Hope to see you at our upcoming event, August 10th in Cleveland. And then in September, we have a Basics of Real Estate full day event. We're going to just go through every single piece of it, every single checklist you need to do it right. If you don't live in California, consider flying out for those events. They're both right by the airport. You could fly in and stay at the hotel. We'll have those details up on our website soon. All right. Have a wonderful rest of your day, everyone. Thank you so much. Take care. Bye bye.